Hi, good morning, good evening. Welcome back to the channel. In case you're here for the first time, this place is for retail investors to become better at investing in the equity markets over a period of time. I've been a retail investor myself for quite some time, and I use this platform to periodically share my commentary on where the market is right now and what is it that I'm doing in a general sense. And because I manage my own stock portfolio actively, I usually have skin in the game, so I tend to stick to what has either worked for me or not worked for me, and usually avoid universal theoretical statements. Now, we know today the market is off because of Christmas, so I thought it would be a good time to just take stock of how the market went by this week. And it was a pretty volatile week. And we'll try and understand why there is so much of volatility in the market. My general view as of now is that it doesn't make retail investors to uh, go really aggressively buying in the market right now. And again, just as a matter of disclaimer, whatever I say in any of these episodes is just my limited opinion, so please use your discretion and judgment before taking any decision when it concerns your hard-earned wealth and money. This is by no means an advisory or a recommendation. This is just me sharing an opinion. So just coming back to the market, it was a pretty volatile week. We saw what happened on Monday when the market fell for close to more than 3%. But then what we saw subsequently in the next 3 days was just manic buying, and overall the market ended up just slightly above where we left at the close of the last week. And we'll just try and understand why this volatility is taking place in the market. What are some of the undercurrents, and why I feel, despite all the hoopla that is going on in the media, that it makes sense for retail investors, especially for those who have sort of not invested the money so far, to, to just be patient and not succumb to this fear of missing out tendency, because we are clearly in very uncharted territory when it comes to interest rates, the inflows that we are seeing in the market, and it can just reverse in a matter of days, depending on how the global environment is moving around and how the COVID situation pans out. So let's just look at the market now. We are obviously on, when I'm recording this, we are on 25th December. And what was interesting to note was we saw how the market fell sharply on Monday, and I've sort of tried to divide some of the broad forces that are shaping the market right now into some positives and some challenges, and try and make sense of the way the markets are behaving. Now, clearly, the markets fell because of the new COVID strain that came in the UK and the general resurgence of COVID, that has sort of been on the rise, especially in the US and Europe. There was also, what dragged the sentiment was also the fact that the US consumer confidence levels have come down. I mean, there was a recent report that came which indicated that, and also the sale of pre-owned US homes posted the first decline in the 6 months. Now, these are sort of, I would say, lagging indicators in terms of economic activity in the US, and given how globally connected markets are in the present times, whatever tends to happen in either the US or Europe tends to affect the Indian market too. And that was mainly the broad sentiment in terms of why the market fell on Monday, predominantly COVID, but then these other two factors also played their role. What sort of led to the, sharp recovery over the next 3 days, of course, was the fact that there was this huge anticipation of the US Congress finally, passing this pandemic relief package, which they eventually did after a lot of back and forth. One needs to see how it will start having an effect on the economy in the US. Also, as of now, there are indications that the US Fed is not going to touch the interest rates, which means that interest rates are going to stay low, almost next to zero. And what that means is, investors globally are looking for yield on assets, and they will increasingly turn towards emerging markets, including the Indian market, for getting any kind of yield on, their capital. Also, there's this anticipation that some Brexit deal might work out in the next few days. And obviously, there's this whole feel-good factor about the vaccine rollout and what is going to happen now. My limited view is that all these good factors or good indications are already priced into the market. And if you read some of the comments or opinions that are floating around on news channels, um, then especially on the print media, then obviously there are two broad scenarios that are being baked in. One is where the Nifty is going to stay more or less flat in the next year. The second is that there will be further earnings expansion because of the whole cost cutting measures that people have taken. And um, as a result of which there might be some expansion in PE multiples and EPS gain, but it's anybody's guess. I would also want to point out, and I didn't get access to the recent report, but Dun and Bradstreet conducts a CFO optimism index every quarter, where they do a survey of almost 300 to 400 CFOs within India on their sentiment in terms of where the economy is heading. And the recent CFO Optimism Index came out a couple of days back. Once I get the report, I'll be able to share it in my next episode. And that is at its lowest level in terms of the confidence and the optimism that CFOs have with regards to the macroeconomic environment. Clearly, their focus is less on investing to augment capacity expansion, to inorganic growth, and more on trying to curtail their expenses and manage their cash flows. And so, I think it makes sense. At least what I would do as a retail investor is, of course, to be very stock specific and not get carried away by all the chatter that's going on, either on social media or on TV, in terms of how, this is a great bull market and we just need to go all in. It'll make sense to be prudent at this point of time and especially not, take any broad blanket decisions. Of course, if there are any stock specific opportunities, if there are certain stocks which you feel need to be there as a part of your core portfolio, and if you feel they are in the value zone, then please go ahead and do consider them. But at the same time, please don't act as if you've missed the bus and you need to now in panic mode deploy a lot of capital. So that was sort of a long monologue in terms of where the market is right now, just in my limited view. And again, this is not a recommendation by any stretch of imagination. Let's just look at where the Nifty ended. I mean, the Nifty ended marginally on the positive side. And clearly, the story of the Nifty was, this increasing attraction towards defensive sectors. IT was a clear standout, followed by pharma and to a lesser extent FMCG. What didn't do well was energy, metals, and commodities. And let's just, look at chart right now and see what happened. And as you know, I've got all these sectors, Nifty sectors plotted for the last 5 days. Clearly, and again, this is more of an academic discussion because 5 days really doesn't make it too much of a difference. But you clearly notice the yellow lines, which are basically the defensive lines, which I categorize as defensives. Pharma, FMCG, and IT clearly stood out. I mean, IT was up almost 5%, followed by pharma. What didn't do well were the red lines, and the red lines are basically metals, commodities, energies, and everything else was somewhere in the between. Um, and that reflected in the individual stock performance as well. Wipro gained 7%, followed by Infosys, followed by Cipla, HCL Tech, Unilever, Sun Pharma. And the only exception from the non-pharma, non-IT, non-FMCG category was, of course, Bajaj Auto, Asian Paints, which is sort of a pseudo FMCG play, anyways. And that was it, And what didn't do well, of course, was ONGC, Coal India, IOC, all sort of commodity, energy, metal basket, if I can put it that way. Um, Clearly looking at the mid cap and the small cap index ended in the red, while the Nifty was more or less flat. And even in the mid cap index, the two largest gainers were Mindtree and Coforge, which are again sort of IT. And there were other sort of, I would say, you know, uh, middle players. What didn't do well, of course, was some of the banking names like RBL Bank and Union Bank, Manappuram Finance, and also, again, infrastructure related stocks like Jindal Steel, Ramco Cements, BHEL, and so on and so forth. Um, Moving on the small cap index, um, of course, there are many in the small cap 100 index. It was down almost 1%. And in that, of course, it was a broad range of, stocks which did well. But broadly, again, some sort of IT flavor coming out in the sense that there was Persistent, there was India Mart, there was Sonata Software, Tata Elxsi. These really did well. What didn't do well, of course, was again some of the banks. And clearly, this is one trend which you will see that going forward, there will be just, it's not a new trend in the sense that there will be a clear distinction between NBFCs and banks which are well capitalized, which have the sort of room to grow more, lend more, and those which are struggling on their balance sheets or which are likely to lose market share. And the general trend is, of course, private sector banks will continue to eat share from the public sector banks. Also, some of the NBFC names, apart from the top maybe three, four, five NBFCs, most of them are not well capitalized, and so they will be constrained by how much they can lend, and that will, in a way, restrict the kind of growth that they see going forward. So these are some of the interesting trends that are happening. But my takeaway from this week, of course, is clearly that there was this focus on defensive sectors and some of the other names, the sort of the cyclical sectors, energy, metals, and commodities really saw a decline this week, which is just indicating to me that the money is going towards safety. Although one can argue whether there's safety in current valuations in any sector. Um, and but on the overall 1 month trend, if you see the 1 month trend, and let me just pull up the 1 month trend. Um, you know, Realty and metals are still by far leading the pack in terms of the last 1 month's return. Realty has gone up by 16%, metals by 11%, followed by pharma and FMCG and IT, right? And so what hasn't done well is, of course, auto. And I think Bajaj Auto is one clear exception, but I guess everybody else has struggled on the auto side as well. So this was my short takeaway on the market. I hope you found this to be useful. Please again use your discretion before investing in the market, and I'll see you again shortly. Have a nice day. Thank you.